Good afternoon, participants. Welcome to ASK Investment Managers Quarterly Portfolio Update Call. My name is AVS Ramakrishna-Murthy, and I am the moderator for today's call. In recent times, we witnessed that most of the indices have corrected sharply from its peak, largely driven by sentiments, liquidity conditions, and global factors. In this context, to know more about market outlook, how Q3 results panned out across the sectors, and to update on ASK Domestic Resurgence Portfolio, we have Mr. Kuldeep Gangwar, Senior Portfolio Manager, is with us. Kuldeep is having more than 18 years of experience, including over a decade as a sell-side research analyst. His core domain expertise in consumer sector, especially in FMCG and retail. Prior to joining ASK, he was associated with HSBC Securities and Capital Markets as a sell-side research analyst. Kuldeep holds MBA degree from IIT Mumbai and BTech from IIT Roorkee, and he is also a CFA chartered holder. We have divided today's presentation into two parts. Firstly, Kuldeep would take us through market outlook and Q3 results session across the sectors and impact on DRP portfolio. In second part, we will open floor for question and answer session. I request all the participants to type all your questions in Q&A chat box. I will curate and get the answers from the Kuldeep post his presentation. Without further delay, we will start the presentation. Over to you, Kuldeep.
Hi, good afternoon, everyone, and thanks for joining in. As AVS has mentioned that whenever we discuss about the stock market, three things matter, like what is the global macro environment, how is the domestic macro environment, then how the companies are working, and so on. From, say, global macro environment perspective, many of us would be reading, listening, and watching that currently multiple noises are coming from rest of the world, particularly the US. Since the change in the, say, political order in US, we have seen that there is a lot of noise related to tariffs and its implication for rest of the world, including India. At the same time, there is uncertainty related to domestic growth. If we think about, say, Q3 FY25 earnings season, then there had been mixed commentary related to the overall delivery from the different companies. So if we think about the first thing, which is the US, they're talking about the reciprocal tariff on partner countries starting from April 2025. There's a lot of confusion, if I have to say so. Anybody who is having, say, trade surplus, that country is higher on the order as far as the US is being concerned when the so-called tariff discussion is being concerned. From India perspective, US account for almost 17% of overall exports. Though they are, say, reciprocal tariff related concern, it may be in the electronics, it may be in pharmaceutical and so on. At the same time, we do believe that looking at the backdrop of US anti-China stance in past, these sectors should also benefit for different reasons, whether it's electronics, pharmaceutical, and home textile. They should be the beneficiary in the long run, despite currently some concerns related to tariff in those areas. If we think about the potential beneficiaries, so anywhere where the US companies are finding India interesting, whether it's electronics and the IT hardware, that sector should be the beneficiary. Where the India-US partnership is going to be stronger, like tech, energy, space, that area should be the beneficiary. In case of pharmaceutical, we do have the competitive advantage vis-a-vis China. So despite having some concern, which we will discuss in a while, we do believe in the longer run, it's a more of a necessity from the US perspective that this particular sector should also do well. In case of home textile, China's relative advantage is falling due to the rising wages. And another sector is where crude and oil and gas, which may be an active area of interest. Pharma companies, many of them have recently reacted negatively for the potential US tariff. But think from the perspective that India is the largest supplier of the generic drug to US, accounting for almost 40 to 50% supplies. So it's quite anchored to the overall healthcare system in the US over there. If the tariffs are imposed on the pharma companies, it might be required to be passed on to the consumer and the insurers. US administration may avoid steep tariff on the essential drug, as the higher prices would also indirectly impact or directly impact, say, US insurers and the patients. If the tariffs are imposed, it may lead to higher inflation, and substituting India's supplies at India's cost is pretty difficult. So currently they are the concern, but at the same time, we believe that it's a pretty important sector from US perspective. On ultimately, the thing should settle out in the more favorable fashion for our country itself. Next thing is budget. Like many of us would have gone through many articles, it's quite clear that government has tried to provide the tax breaks, and which should be an area like where discretionary consumption can get a lift, whether it may be low ticket discretionary item, it may be consumer durable, it may be two-wheeler and so on. So that is an area which is definitely going to get a boost post the budget. Second is like there had been some concern related to capex part, but please look, like even in the capex area, like budgeted number is close to 11.2 lakh crore, and it's almost 10% higher number vis-a-vis say FY25. And when we compare the vis-a-vis FY25, it's still a decent number, because in FY25 the capex growth was only 7%. At the same time, the government is on the path of say consolidation as well as maintaining the fiscal prudence. So current account deficit as well as the gross fiscal deficit, those remain the two areas, especially when we talk about say fiscal deficit part. The targeted number should be ideally lower than the current year number. So it's on the consolidation path, it's on the right trajectory. So overall, if we have to say so, like it's a budget which suggests the measured optimism, and it should provide some say tailwind to the overall consumption in the country. If we have a revisit of the 2024, then it was a year of elections. There were certain climatic conditions like a lot of heat waves and so on. Logistic costs, especially the Red Sea crisis, led to relatively higher logistic costs for many exporters. We have also seen the Bangladesh crisis. And from IPO, QIP, OFS perspective, a lot of money raising also happened in 2024. If we think from the sector's perspective, infrastructure did well because there was a theme of energy transition, circular economy, and electronics manufacturing. As well as another area was like new age tech as well as hospitality. From the stock return perspective, H1 was relatively better when we think from the calendar year perspective. S2 was relatively tougher because it grappled with say, various macro uncertainty, especially in the say October to December period, primarily led by say changing global order and earnings downward revision. Current quarter, the earnings signals were mixed. Going forward, we do believe the earnings should get a support from a decent marriage season, good rabi crop. Also, say government capex should pick up, because if we think about FY25, Q1, the capex was impacted because of the general election. Q2, we had the extended monsoon. Q3 onwards, the things have started coming back, and we believe the Q4 there should be a pickup. If we think about overall India market construct, we have seen that India market underperform relatively vis-a-vis say overall global markets, and reversing the trend of outperformance what we have seen in the previous year. Moreover, the fall was more intense in the mid cap and the small cap area. So mid cap corrected by almost 20%, while small cap corrected by 21% from the recent peak or say 52-week peak. And we have seen portfolios where the tilt was more in favor of mid cap and small cap. Largely everybody was impacted. Corporate earnings side, more or less in line number. In the slow earning scenario, we do believe that a sustained and superior profit growth should command a valuation, polarization, and valuation premium. This is a snapshot which suggests that India had been relatively underperformer in CY25 till date, especially till 14 February 25. Probably the second worst performer. And this picture also does not give the full, say, glimpse of how broader market is doing. In fact, the mid cap, the small cap, broader market correction had been even sharper. And irrespective which pocket we would have gone, the outcome would have been quite similar. So despite India going to be one of the fastest growing economy, either in the near term and medium term, and most of the macros should also improve in the coming quarters and the coming years, having relatively better foothold, still we were probably one of the worst performing market in general. And in the broader market terms, the correction was even sharper. Why it is happening? Like if we look the currency perspective, INR has depreciated vis-a-vis USD, and whether 3 month and the 1 year, the depreciation had been quite sharp, and it did impact or it does impact, say, overall USD denominated return. So whatever say currency strength we have seen earlier, to some extent, the normalization is happening as we speak. So-called overvaluation status is now moving up away, and the things are getting normalized as far as the currency is being concerned. From a FI perspective, it's a USD denominated return matter. So whenever there is concern related to macro currency and so on, or uncertainty is there, the FI withdrawal may accelerate. What probably we have seen in last 1.5 months. It was already happening for quite some time, but it accelerated in last 1.5 months. We do believe that probably we will be seeing, say, this currency stability in due course of time, and large part of the pain would have been already taken by the market. And this should not be a material factor, probably in, say, 3 months or 6 months time. This is our understanding. From the overall dynamics perspective, the positive outcome is that crude oil prices have come down. And we believe in the current scenario, when Trump is in the, say, overall scheme of thing, as far as the global macros are being concerned, we will like to believe that crude oil may remain in a particular range, and probably this particular scenario may be favorable for our country, because we are one of the largest importer of the crude oil. From the FI flows perspective, we have seen that things started worsening for India, especially from October 24 onwards. And from October 24 onwards, there is almost $22 billion outflow. And it was more accentuated in favor of secondary market. Like this picture gives the summary of how the FIs have behaved. It's a sum total of secondary market and the primary market. So we have seen the net withdrawal at both the level have accelerated in January and February, which had the implication for both currency as well as, say, overall market indices as we speak. From our domestic
Kuldeep, we lost you. Participants, sorry for the inconvenience. Kuldeep is, rejoining. There is some technical issue. Sorry for the inconvenience.
Hello.
Yeah, Kuldeep, you're audible.
Yeah. So there was some technical issue. As we were discussing that across market cap, there had been different performance in recent time. So if we think about mid cap and small cap, CY23 and CY24, there was strong outperformance coming from this particular quarter. Like mid cap would have delivered almost 47% return in CY23. Similar was the number in small cap. In CY23, despite having some correction from October to December, there was a reasonably strong calendar year performance coming from mid cap and small cap. If we think about current year CY25, particularly 1st January 25 till mid-February, there had been significant correction which happened in case of BSE mid cap and the small cap index. So whatever the correction we have seen, it was quite concentrated in favor of mid cap and small cap. And if we think about intensity, like even index is not giving the full picture. If we think about overall BSE 500 index and look at the small cap, almost 68% of the stocks in the small cap would have fallen more than 30% from its 52-week high. Mid cap area, the number was almost 60%. Large cap were relatively stable. And similar replica from the January 25 till date. So irrespective which sector you had been, the situation had been quite similar. Indiscriminate selling happening in the mid cap and the small cap space. So whether it had been consumer, pharma, anything you can think of, as long as it belonged to that particular area, there had been indiscriminate selling. But at the same time, we will like to highlight that whenever the sentiments are negative, these things do play out. After a while, when say whether it's a global macro, domestic macro start settling in, say some sort of stability come into the picture, a sanity do come back, and the reversal generally do happen equally fast. Because when we think about large cap, it has more to do with the earning growth potential. The earning growth potential has come down in recent past, particularly in FY25. While mid cap and small cap are still delivering the decent earning growth. And we do believe ultimately the stock returns are just outcome of say strong earning growth. Like as long as the companies are delivering on ground, say stock return do follow. In short term, the sharper correction is always possible, but it's more like a short-term situation rather than any long-term change or trend changing over there. We have seen in FY24, like PSUs have done quite well. Like they used to be almost 10% of the benchmark and moved by almost 89% and almost accounted for quarter of say benchmark performance. In FY25 till date, some sort of reversal is happening. Like though their benchmark weight has increased to close to 12%, but there was almost 7% correction in the PSU pack. Why we are highlighting? The point is like one way up move or one way correction, neither of that lasts. The mean reversion do happen, and we will see in due course of time anything which is solid on ground, having a strong fundamental, will come back as and when some stability do appear. From the valuation perspective, Nifty would be close to it's a 10-year average P. So valuation growth is not there. Earning was the issue in FY25. We expect some pickup in the earning growth in say FY26, which should help the overall broader sentiment for India equity market. And we will like to believe that the growth trajectory may be even stronger in the mid cap and small cap. So once that stability sentiments reversal do happen, then we will like to have a faster recoup of say correction what we have seen in the recent times. DRP, this is a snapshot of the changes being done in financial year 25. So we have increased the weight in favor of manufacturing, infra, consumer discretionary, EMS space, healthcare space. At the same time, we had made exit in financials and some of the consumer discretionary names. In January month, when the correction started happening, we started introducing some of the position like Dixon, Keynes, Newland, Senco. Though after introduction, there had been some correction, but we tried to capitalize on the correction which was witnessed in these companies, because we believe these companies offer quite durable, sustainable long-term growth, and the quantum of growth should be also quite strong. So Dixon is basically the representative of a Make in India campaign, and basically it's a poster boy of that China plus one strategy. The PLI incentive, etc., which we have talked about in past. The company is growing quite strongly, having presence across multiple domain, whether it's a mobile, home appliances, lighting, consumer electronics, etc. And we believe this company can grow at 40% plus CAGR for at least medium to say long term. By that I means like at least 4 to 5 years. And in that situation, this is probably one of the good company to have from the portfolio. And recent time, we have witnessed decent correction. So we started adding this particular name in our portfolio. Second is the Kane. Again, it's coming from the EMS space, offering pretty strong growth, getting into the new areas, diversifying its revenue potential streams over there. And again, we have seen, say, decent correction happening in this name as well. So we started building our position in this name in the January. We expect again this company can also offer 40% plus earning growth for next 5 years at least, and quite a high growth area, and the correction should be capitalized. Next is the Newland. Newland is having two revenue stream. One is say intermediates for API. Second is the contract manufacturing. In case of APIs, again, they are two different segments. One is say generic, where they are providing say high volume, low margin APIs, which we call the prime APIs. And second may be say low volume, high margin APIs. Split is almost 50-50. FY25 had been a bit challenging because in case of CMS space, one of the campaign was not available, and we will like to believe that things should start getting back into say positive trajectory in FY26, because even with the existing portfolio, the company can grow at 20% sales CAGR. And if we have to think about say incremental opportunity, there will be commercialization of one of the product in about 26. They are having two products which are under the phase 3 trials, and one of them should go in about 27. All in all, there is decent visibility for almost 20% plus growth at the revenue level for next 5 years. In fact, for next couple of years, over about 25 base, we will like to believe almost 35% plus earning growth in this company. Again, this stock also corrected from 18,000 level, and we started building our position during this correction. Next is Senco Gold. Senco Gold is in the jewelry space, large presence in the East India area, and they are building presence in the rest of the country as well. From say growth perspective, we will like to believe that this company can deliver 18 to 20% growth. Margin should be more in the range of 7 to 8%. There had been correction even in this name, like, and it has more to do with some of the trend which we have observed across the jewelry sector. Like in FY25, all the jewelry players impacted because of say duty cut. And whenever duty cut happen, it impacts say profitability negatively. So this company also get a one-time impact of close to 57 crore because of the duty cut. Second thing was like in this particular quarter, there was hedging loss vis-a-vis say hedging gain available last year same quarter. So overall reported number appear not so great, and that's the reason there had been sharp correction. We have quite a small position in this particular name, but at the same time, we are quite confident that the thing should start coming back from Q4 onwards. So we expect almost 20% revenue growth in Q4, margin again going back to 7% plus, as well as far as the EBITDA is being concerned. And from 3 to 5 year perspective, our understanding is this company can also deliver, say, 18-20%
Again, there is some technical glitch. Apologies for that. Please request participants to hold on the line. Couple of seconds, participants. Kuldeep is rejoining again. Apologies for this technical glitch.
Yeah. So this is the psychography of let's say DRP portfolio. We have overweight position in the infrastructure engineering and the consumption part. And we have relatively underweight position in the financials, while we have built the position in the healthcare area over there. Market cap capitalization perspective, almost 40% is large cap, balance 60% is in the mid cap and the small cap space. And this is a snapshot how the overall market cap exposure moved in last 3-4 years. So there had been relatively higher exposure in mid cap and small cap. And it is more to do with, say, new growth opportunity coming in those areas. Like we have taken the position in case of Gravita and Newland and Cure and so on. So it's more driven by bottom up rather than our willingness to have a certain exposure in terms of the market cap. So this is an outcome rather than the driving factor. But what happened in January to February period, anything which was present in the mid cap and small cap, there was sharp correction, which also impacted our portfolio performance. At the same time, I'm saying that though many things can go down together, but at the same time, there are only few things which come back in any cycle. So as far as our companies are being concerned, we have seen that they are delivering earning growth despite so much concern about the slowdown and say what's happening to overall macros, whether domestic and the global. This is a snapshot of the companies which we are having the portfolios. So from the PAT growth perspective, pretty strong earning growth for almost 5-year period from FY19 to 24. At aggregate level, almost 30% earning growth, vis-a-vis say 15-16% earning growth happening at the Nifty level. And it did translate into the stock return part as well. If you look the right-hand column, so if the companies were able to deliver earning growth, it was translating into the stock return as well. But in FY25, though earning growth is still remain quite strong, like in Q3 FY25, when there had been many noises regarding the slowdown, lower earning, decline in earning, portfolio level operating profit growth was close to 18%, at PAT level more than 20% earning growth. Similar had been the trend for the 9 months, like almost 20% earning growth. At FY25 level, we expect the overall portfolio should deliver more than 20% earning growth, vis-a-vis Nifty delivering mid single digit over there. And the difference should further increase or in terms of the growth trajectory. Like we expect almost 30% earning growth in FY26. So earning growth had been there in past. Earning growth is there in FY25, and it should sustain even in future as well. This is the overall psychographic of the portfolio. Like earning growth is quite robust. At the same time, ROC are quite decent. We have seen in last couple of years, many companies which were just delivering earning growth at the time, their ROC may be relatively inferior. Everything was moving up. When the character come to test, we are going through that particular situation as of now, and we expect not everything will come back, but at the same time, if you look our companies, they have the resilience of delivering earning irrespective of the market cycles, and they should be treated at premium, and market will recognize the moment the first sense of stability come into the picture. We have argued in past, in portfolio return, stock return, only two things matter: what is happening to the earning growth and what is happening to the valuation. Currently, the valuation are lower than anything what we have seen in COVID-1, COVID-2, Russia, Ukraine. So if the valuation level used to be trailing valuation level used to be say X, currently valuation may be 20% discount to the same. And please understand, currently we don't have any existential crisis, we don't have any credit crisis, we don't have any financial crisis. There are certain concerns coming from say global side, certain concern domestic side, but all of those concerns will get addressed in next 3 to 6 months. The moment it happen, it will be again driven by only earning growth, and that is the area where our delivery had been relatively more consistent, and that earning growth should be appreciated in due course of time. This is a snapshot of the performance. Like last 1 month had been tough, particularly January, and till mid-February, the trend had been quite similar. But in last week or so, the things have started coming back to some extent. So we lost a great deal of alpha in financial year FY25, largely pulled down by say overall January. But as I have argued, like in January to February period, 45 days period, there had been correction all across, particularly sharper correction in mid cap and small cap. And it has nothing to do with the fundamental part in many areas. Like there were many companies delivering pretty strong earning, but still almost 30-40% correction did happen as the sentiment became quite negative. And obviously there had been chatter about the valuation per se. Today, the valuation of many companies have gone at par or might be a discount to the companies which are offering relatively pretty muted earning growth, if I have to say so. So it can't stand true for a long period of time. That valuation premium for the growth companies is bound to come back. And this is something which we believe in, that as long as the company deliver on ground, it has to convert into the stock return part. So whatever we have seen in last 45 days, it's a more broader correction. The moment some stability, sanity is coming back, many things should come back. And this is the way we think about it. From the risk perspective, the higher crude oil prices is one of the area of concern. But looking at the current situation, we will like to believe that crude oil may remain range bound. Adverse policy move by the US is something to watch out for. And last but not the least, like this significant deacceleration in the global growth, it's going to have impact for everybody. I will stop over here and happy to have any question which you might have.
Thank you, Kuldeep, for your narrative. I would request all the participants to type your questions in Q&A chat box or chat box, and I will get the answers from Kuldeep. Request to start, type your questions now. Kuldeep, you can pull down the presentation so we can view, better. Yeah, thank you. So before we got any questions in our Q&A session, we also curated some questions from our distributor partners and investors. I will ask those questions now, and if any questions come, and I will take that in. So DRP portfolio is now, if you directly come into the portfolio, now more skewed towards to the, though you mentioned that it is not on the, we are at the bottom of stock pickers, it is not on the large, mid and small cap. But having said that, 60% of allocation now into mid and small caps. At these current situations, do you feel this still the valuations are in the right direction, or you want to move some part off into the large caps going forward?
So if you look large cap as a pool, the earning growth potential came down significantly. In FY25, I mentioned that earning growth was only 5% for the Nifty, while mid and small is still delivering the healthy numbers. So what happened in say FY25, most of the large cap were anyway underperforming. And even in the say last 45 days period, it's more about not coming down dramatically. So it's not the case the large cap are moving up. It's more about the correction had been relatively lower in the large cap. And we have argued even in past, ultimately it's only about earning growth. So the shift which we have mentioned, like larger presence of say mid cap and small cap, it was only driven by our willingness to go for the new areas which offers a faster durable growth over a period of time. So
Kuldeep, again, you're
next slide. Okay. At the same time, if we think about correction, almost a 30% correction or higher has happened even in that team. Same is the case with in another sector like Radico. Again, we expect this company can deliver 20% plus earning growth for at least 5 years. At the time when most of the other consumer companies are delivering muted growth, single digit growth, and so on. So delivery had been there in past, delivery is happening as of now and should sustain. At the same time, stock came down from 2700 to almost 1800 level. The moment some stability came within a couple of days time, it has again gone back to say almost 2000 plus level. Same thing happened in the other area as well, like the transformer rectifier. That company is delivering 200% plus earning growth. Like in FY24, if the PET was close to 40 crore, we will like to believe this particular year the PET may be close to 170, 180 crore. And next year this number may be even higher, close to 300 crore. That company made its a recent week in January, almost 600 plus level, stock corrected to 365 last week, and then again came back to 430, despite delivering that 200% plus earning growth. So the only point I'm trying to highlight again and again, our shift in favor of mid and small is driven by more bottom up, the companies which can deliver for a sustainable period of time. But we also know that when we have relatively higher exposure in mid and small, volatility do come into the picture, especially when there's a lot of negative news coming from either the global side or the domestic side. At the same time, as long as we are confident that these companies will deliver, the prices do come back. That's the reason I'm saying it may be the case next 3-6 months that we have more clarity regarding the tariff part, some stability coming, some relatively not so negative news coming from rest of the world. Our own growth pickup, like we have seen, GST was double digit in recent month, and if that sustained, we have no reason that why the things will not come back. So it's more of a matter of time that as long as the companies are delivering earning, it is going to get appreciated.
Thanks, Kuldeep. We have a question from participant Mr. Vijay Mehra. He's asking on that DRP has consistently underperformed benchmark BSE 500 since inception. Can alpha be generated in next 3 years?
So DRP had its own up and down, but at the same time, we had relatively stronger performance in the tough time. Like in FY20, when the COVID issue happened, the DRP would have come down by 16%, vis-a-vis market coming down by 27%. Even say, I would say CY21 to CY24, which had been relatively difficult year for the growth as a style. Like growth as a style does require that a relatively lower interest rate, a stable interest rate, and it was not the case at all. Like from October 21 till CY23, you can say the interest rate were moving up. in the higher interest rate scenario, say value as a style does relatively better. So for 3 years in a row, our style was not in favor. Still, I would say DRP was doing relatively okay. And even in say FY25 till December, there was a decent alpha. And in last 45 days, it has more to do with like mid and small getting hammered, irrespective of say fundamental trades in those names. And the way the things can go down, it can come back equally strong as well. Like we have seen in FY21, that was year of two half. In the first half, April 20 till September 20, DRP was not able to do well for simple reason. We couldn't take the position in the export areas. But when the reversal happened from October 20, say rest of the 6 months or year, the fortune changed equally fast as well. So today, I will say it's a quite dynamically managed portfolio, and current say overall mix like mid and small brought it down. At the same time, underlying companies are delivering quite consistent basis. I have shown the snapshot for the same reason, like whatever had been the companies in the DRP portfolio in FY19 till FY24, if they have delivered earning, it did translate into the stock return. In FY25, though the companies are delivering earning, because of so-called sentiments and negative news around, it did not translate into the stock return. But at the same time, it has to reverse. It may be the case of 3 months or 6 months, but whenever the reversal do happen, we should come back quite strongly. Reason is like as I mentioned, if our style was not in favor, like growth as a style was not in favor, that should not be the case anymore. Like we have seen in February, interest rate has started coming down, and if further incremental correction happen, incremental decline happen in case of interest rate, it should further provide tailwind for the interest rate. Even if it does not happen, please think from the perspective, earnings were coming, but still valuation derating was so sharp that overall, say, performance was not commensurate with the overall earning growth. I'm saying even if, say, so-called interest rate cut does not provide a tailwind, but remain a neutral factor, even in that scenario, we should do well because earning growth side in about 25, we expect almost 20%, and next year the number should be even higher. So from a style perspective, we think growth as a style is coming back, and it should augur well for the DRP as well.
So thank you, Kuldeep. Hope we answered the question, Mr. Vijay Mehra. So Kuldeep, if you see the post-budget, the sentiment towards the consumption has become very, very strong. Since you also closely watch the consumer as a consumer sector very closely. So what's your take on this FMCG and retail part? How do you see going forward looks like in terms of valuations? And are you looking for increase some more weightages in your portfolio?
So consumption is having two parts. One is the staple, second the discretionary. I will like to believe just because the tax rates have come down, there should not be material delta on the staple side, like FMCG side of it. There may be some premiumization benefit, but it should not change the trajectory meaningfully. The most of the benefit of say will come in the discretionary consumption side. It may be footwear, it may be say consumer durable, it may be two-wheeler, it may be four-wheeler, and so on. So that discretionary consumption should take a boost because what we are talking about that all the incremental benefit are available to the people who have the income more than 7 lakh. Anyway, below 7 lakh, people were not paying the taxes. So incremental benefit is coming for the household where the income is more than 7 lakh. And FMCG is not a concern for that particular pool. It's more about the surplus coming and probably getting into the area for so-called desires which were not getting fulfilled so far. So we will like to believe that for almost 4 to 6 quarters, discretionary consumption had taken a beating. It may be say footwear, it may be retail, apparel, QSR, and so on. They all should come back, particularly in FY26, because of this additional surplus available in the hands of the people.
Thank you. Since you talk on the retail segment, if I ask the question on the Vedant fashion, what is your take on Vedant fashion? It's continually underperformed the portfolio overall level.
So Vedant is having a lot of dependence on, say, marriage as a season and overall, say, discretionary consumption part. As I mentioned, that discretionary consumption had taken a beating for quite some time, and it was not specific to Vedant. It was more of a, say, overall broader environment like that. If we look, footwear companies, similar situation, QSR companies, similar situation, apparel, similar situation. So expectation is that probably they should start coming back. Like even in Q4, the marriage season is going to be quite strong, and the base is relatively benign. So at some point of time, there should be a break from, say, past in terms of, say, change in fortune. And given, say, marriage season is going to be conducive, and the surplus which we discussed in terms of relatively more surplus in the hand of the people, probably it should help to that particular company. And the fortunes change quite dramatically. Like we have seen Vedant was almost at similar level last year as well. On the moment we start getting a feel that probably the quarter number may be good, the stock moved to almost 1400, 1500. So the things can move pretty dramatically in a single quarter. It's a decent franchisee. At the same time, we always remain watchful for any holding which we are having. So we will see whether the fundamental performance is coming back or not. If it's coming back, then the price is just an outcome.
Thank you. So if again I talk on the budget on that, one side is the consumption, another side is it into the capex. So we have seen the bulk of heavy lifting capex is coming from the government side. So when do you see the private capex is coming into the flavor in India?
Difficult to predict, but at the same time, capacity utilization in general has moved beyond 70% plus. So it has to happen. And many companies are announcing across different domains, like because they are coming to the level that it's very difficult to do further optimization. And wherever the growth is happening, we have seen the Varun Beverages doing in, say, FMCG part of it. Same thing is happening in, say, manufacturing, like Gravita, etc., doing the capex. So wherever the growth opportunities are there, the capex has already started happening, and the moment the capacity utilization level moves further up, we find no reason why the private capex will not pick up. So both government as well as private capex should do well in years to come.
Thank you. I would request participants to type your questions. Now before that, as we are discussing about capex, you are also increased your allocations in capital goods and in infra and engineering. It is sharply fallen in recent times. What is your take on that? And especially stocks like APL Apollo Tubes, the segment like cable and wires, whether it is Apar Industries, KEI or Polycab, fallen sharply. What is your take on that?
So I mentioned this particular part, anything which belonged to mid and small, it suffered sharp correction. And that's the reason I had put in a snapshot that almost 70% company, 60 to 70% company, which belong to mid and small, the correction was more than 30% from 52-week high. So currently, it was not one versus another. Literally, everything has come down. And it happened at the time when the growth was quite strong. Like if you think about care industry, which you mentioned, almost 20% plus revenue growth. In case of Polycare, the number was even higher. So growth was not that big a challenge in those areas, but it's still, even at that time, it happened. Same is the case with APL Apollo. After a long time, their growth is coming back, and we expect that FY26, etc., the number should be quite strong. And in fact, APL Apollo did not suffer that much of a correction, but probably the broader market is seen in recent times. Everything has come down, quantum is different. But at the same time, I'm saying that it's not infra, manufacturing, and capital good area only. We have seen the similar sort of correction in pharma, we have seen the correction in consumer. So it's across the board as long as it belonged to mid and small, because a lot of activity was happening in CY 23, CY 24. People have made good money whenever some concern, uncertainty do come into the picture. The profit booking do happen. But at the same time, a good franchisee remain good franchisee. Sooner or later, the appreciation of the earning is bound to happen. And we have seen in different cycles, like things may go down together, but not everything come back in tandem. Like the stronger franchisee come back the moment first sense of stability come into the picture.
Thanks, Kuldeep. If I ask the question on banking and financial services, though the valuations are in a comfortable zone at this situation, so you have very limited exposures to, especially into the banks, and we have only one stock, which is State Bank of India. So what is your view on BFSI as a sector and the NBFC names what we are holding?
So we are playing the BFSI through NBFCs, like we have Bajaj Finance, Chola, and REC over there. So what happened for a good length of time in last 4 or 5 years, the appreciation of growth went away. Like we have seen the number of both private as well as say PSU banks, everything was delivering good number because they were coming from a trough, and the NPAs have come down, so credit cost was lower. Everybody was delivering pretty decent number. So so-called valuation premium, which generally comes from the growth, was not anymore the case, especially in case of Bajaj and Chola. I will argue that FY19 till almost FY24, 5 year period, it was pretty strong growth across quarters. So we stop making any distinction, somebody who can deliver on the sustainable basis, and sometimes we start giving, say, almost same amount of credence to short-term performance as well. I will like to believe that growth will be no more as democratic as it was in past. Like there will be certain pockets which will be delivering strong growth, the way we have shown. In our portfolios, almost 70 to 80% companies would have delivered 20% plus earning growth in so-called tough quarter. And it did not happen for this quarter. It happened for last 9 months. It happened for last 5 years, and it should continue. So the divergence in the growth trajectory will again come back, which was probably the missing element. And that's the reason the so-called premium of the growth style had faded away. It should again come back. Like there will be few pockets across sectors. There will be the companies who can deliver growth, and other one-time wonders will go away. So whether it's a Chola, whether it's a Bajaj Finance, etc., they have delivered in past. We believe they can continue to deliver 25% plus earning growth. That is not the case with many mainstream lenders, like which you mentioned. At NI level, say net income growth level, we will like to believe the overall private banks may deliver low double-digit growth. At a system level, the number should be quite similar. So at best, we are talking about low teen to mid-teen earning growth. At the same time, our exposure in Bajaj, Chola, etc., should deliver more than 25% earning growth. So it's more in line with our philosophy that to go for superior earning growth. Those short-term hiccups do happen, but ultimately we stick to what we believe in. And that's the reason whether Bajaj, Chola, REC, those are the names through which we are playing the BFSI part of it. You rightly mentioned the valuation have come down in the private lending side. Now, the issue is something else. Like right now, when the FIs are selling, so ownership also play a role. Like when you think about, say, BFSI sector, a large part of the free float had been held by the FIs, and somebody can sell what probably they own. You can't sell anything else. So this ownership issue is also playing out for last 2 years or so. So two things. First of all, the earning growth has come down vis-a-vis the past. And second thing, like this FI selling is also putting pressure in those areas.
Thanks, Kuldeep. So in a discretionary segment, you have exited Titan, and you also added, same segment which is into Sanco Gold. So what is the rationale of exiting Titan and add the similar name into the Samco? Though Samco you have explained well. Now, what would be the reason for exiting Titan in the same discretionary space?
So it's more about like similar sort of growth at lower valuation. So in case of Titan, I will like to believe the earning growth trajectory may be mid to high teen, like 15 to 18%. In case of Senco, I will like to believe the earning growth may be 18 to 20%. And I'm talking about more 5-year perspective. I'm not talking about a quarter. I'm not talking about a year. From 5-year perspective, if Titan can offer mid-teen, high-teen, this company can deliver 18 to 20%. Valuation perspective, when we made this particular change, the valuation was almost half of what at which the Titan was available. So similar or higher growth, but at half the valuation was the overall deciding factor. After that, particularly I mentioned that it belonged to an area where a lot of correction is happening. At the same time, it coincided with the relatively weaker performance optically. Why I'm saying optically? Like Q3 last year had the benefit of almost 68 crore one-time benefit of hedging gain. And this quarter, they are twin negative. One is say hedging loss as well as a custom duty related impact. So it compounded the overall measuring. Otherwise, I will like to believe that in Q4 itself, the number should start coming back. And when there is sustainable delivery of the earnings and some sentiment stability coming from say overall mid cap, micro cap, small cap perspective, I think the thing should come back for Senco as well.
So thank you. Final couple of questions for the day. Kuldeep, what's your view on Adani Energy Solutions? It is continuously dragging or underperforming. It's a detractor for the portfolio for so long. How do you see this particular name in your portfolio?
So again, we have taken this particular name more driven by earnings only. Like if we look, this particular company is delivering pretty solid earnings in recent times and probably should continue to do the same for many years to come. And we are talking about 20-30% earning growth, which is not a common factor in many, say infra manufacturing side of the story. So it's more about that, but it coincided with say negative news coming from say either US related to promoter etc. But at the same time we have seen that as long as the fundamentals are intact, earning is coming sooner or later, appreciation is bound to happen. So this time we have seen say sharper correction in mid and small, that too in the tune of 30, 40, 50%. But large part of the correction had already happened in this particular name. And this time the correction in last 45 days was not that sharper. It's more about that all the area where they are, whether it's a transmission or distribution and the smart meter, as and when the numbers are coming, sooner or later the stability and the appreciation should also come back.
Thank you. There is a question from participant. It is again related to the NBF bank, bank BFSI segment. So, what's your opinion on the capital markets and insurance under financial services? Why do we not see any exposure to the stocks in this segment, as they are domestically structural themes?
Agreed. So it was more about having a higher exposure in manufacturing infra. Ultimately, we have to budget for different sectors. So some of the names have done well and done quite well, if I have to say so. At the same time, the areas where we also ventured into were offering equally strong profile, like whether the Gravita or say transformer rectifier, etc. They were also offering say 30-40% plus earning growth, and that to a great length of time. So we always have to make certain choices. In case of BFSI overall, if we think about growth trajectory pre-COVID and now, the growth trajectory is coming down. Pre-COVID, for say lenders, I have mentioned almost 20% plus earning growth used to be the case. That number has come down. So that's the reason we have exited from say private bank. At the same time, we maintained our position more like NBFC side of it. And at any given point of time, it's a trade-off. Like if you have to brought in something, probably you have to either let go or you can't take the position in some of the other areas. So capital related, say stocks have done well, no denial about it. It's more about that we wanted to have higher exposure in some other areas more linked to the economy, and that's the only thing which had been the reason of that sort of allocation.
Thanks, Kuldeep. So we don't have any further questions from the participants at this current situation. Would like to have your final remarks on how investors needs to look our DRP portfolio going forward. As one of the participants mentioned, the performance is drag, and we expect our numbers are very lucrative, superior in terms of earnings growth, PAT growth, and capital efficiency wise. So your final remarks to our investors, how do we take it forward for the growth DRP portfolio?
So I'm making only one point, like 3 years at a stretch. If I have to say, growth as a style was not in fashion. And it happened with anybody who is practicing that particular style. Like we are a growth investor. Reasons were many, whether it's a global, domestic, etc. And whenever it happened, it is having implication for overall portfolio performance. I'm saying the things are changing now. We have already seen the first evidence of the same, like recent interest cut by, say, RBI. And we should not be surprised if more are in offing in due course of time. If it happen, it's a positive news for equity in general and more so for our growth style. And I'm saying that even if it is not providing incremental tailwind, at least this particular situation will not be a drag on the multiple. So even if the multiple say stabilize and do not have any further re-rating, even in that scenario, a large part of the earning growth will translate into the stock return, which had been a constant. Like even in past earning delivered, now it's getting delivered and should be the case even in future. So from a style perspective, our own positioning perspective, we will like to believe probably the worst is over, or probably we may be at the fag end of so-called adverse scenario. Currently, all the three factors like global macro, domestic macro, all these things are leading to a confusion, if I have to say so. And it will also go away in next 3 to 6 months. And after that, I will like to believe everything should fall in place. Like there should not be any further drag, material drag on the valuation, and earning should be also remaining quite strong. So from say style perspective, we should be back. Earning perspective, we had been there, and the combination of the same should provide relatively better performance in years to come.
Thank you so much, Kuldeep. Thanks participants for joining the webinar today. And with this, we'll end today's webinar. Thank you so much.
Thanks. Have a good day, everyone.